Okay, so today we're going to be looking at chapter 10, which is a pretty long chapter, but the good thing is it kind of builds from one concept to another, and they're pretty similar. So once we get the first basics, we're going to just build onto it in different concepts in the rest of the chapter too. So this chapter we're going to be looking at plant assets, so we'll review what they are. We're going to get into what natural resources are, and we're also going to finally look at what intangible assets are. So when we first get into this, we're going to be looking at plant assets. So those are things we've seen before. We started using them way back in chapters 1 and 2. Plant assets are the things that we're going to have for a long period of time. So they're things that have a physical component. So it's something that we can physically touch. We're going to use them in our operations every day. They're typically used to benefit some kind of a future period. And when we think about that, we're also going to be looking at the category they fall under. So they fall under something called property, plant, and equipment. So some companies might just call it plant assets. Some companies might call it long-term assets. But it's those things that we're going to keep on our books for a long period of time to use. And we're going to go over some of those details in just a second. So when we look at some of the issues that we come across with plant assets, we first have to think about, what is that cost to actually acquire that asset? So there are some basic things we're going to look at as what's included in that cost. Obviously, we know what we pay for it is included, but there's some other factors that can be added in too as far as what's included in that acquisition cost. And we know that, while they're going to last for a long period of time, they don't last forever. So at some point, we are going to either need to replace them or get rid of them. So what we're trying to do is record that decline in the book value over the useful life of that asset. And we talked before in chapter 3 when we did our first entry for depreciation about the straight line method, and we looked at what the useful life is. So how long do you expect it to be useful in your business? That's what we're talking about when we say useful life. So we're going to be spreading out our cost over the useful life. So let's look at what's going to happen as far as how do we determine that cost. So we're thinking about it. Obviously, the price we actually pay for that asset is going to be included in the purchase price. But any expenditure that we have to get the asset ready to actually use it can be included in that cost. The other part is things that are, getting it, like when we're thinking about like setting it up, testing it out, those things that are getting it ready to actually use. So let's look at some examples of some of our plant assets. And again, we've seen these before. This part's not new. We're just reviewing them and looking at that cost determination or the acquisition cost, what will be included in that for these types of assets. So our first one we're going to look at is machinery and equipment. With machinery and equipment, obviously for all of these we're going to have what do we pay to get it. So we have the purchase price. But for machinery and equipment, we can also have taxes that we might have to pay for it. We also might have to install it. We might have to put it together. We have to test it out. Those are all things getting it ready for its initial use. So we're going to look at those. We might have transportation charges. We might have to pay for insurance while it's being delivered to us. So we want to make sure it's protected in transit. So that's what that insurance in transit is going to be. The other thing is going to be buildings. So we might have a building that's already done, which we would just be paying for the whole thing. But we might have a building that we're actually going to put together and create from the ground up. Either way, that cost for the building is one part of the fee or the acquisition cost. But a lot of times when you're buying real estate, there's other fees that go along with it. So you're going to have title fees, attorney fees for settlement, brokerage fees because they're helping you process the mortgage or the loan on it. And then you're going to have the taxes that go along with that. So that's all included in the cost of buildings. The next part we're going to look at is land improvement. So this is a newer category. We haven't talked a lot about land improvements. So this is its own asset category, and it's going to include things like parking lots, driveways, fences, sidewalks, our landscaping, lighting systems, and those are the things that are doing exactly what it says. It's improving the land that you own. So we're going to depreciate them over the useful life of the improvements. So, we know that a parking lot is going to last for a long time, but it doesn't last forever. It might have to be completely redone, and during that long period of time, you might also be resurfacing it. You might be doing things to protect it, but we're going to depreciate that acquisition cost over the life of that asset. The other thing, when we think about landscaping, yes, it lasts for a long time and you might update it, but that initial cost is typically what you're looking at for that land improvement. So all of those types of assets are going to be depreciated over the life of the asset. But there is one long-term asset that we never depreciate, and that is land. So while building might have to be replaced eventually, your equipment, your machinery, your driveways, those kind of things might have to be replaced. Land is never replaced. Your land is always there. You might have to fix the land improvements, but you never have to replace the land itself. So that's why it's not depreciable. So when we look at what is the total cost of land, we are going to be including the purchase price. We're going to be looking at property taxes, title insurance while you're getting that settlement done, any real estate commissions for buying it. They do a title search. There are fees included with transferring. So all those settlement kind of fees are going to be included. Same thing with land as in what we saw with building. So those are all costs that can be included. Now, one thing we have to think about is, sometimes we're buying a property and it has land, it has a building, and it has land improvements. So it has a parking lot or lighting or shrubbery, but it has the land and the building already done. So we had to figure out, how do we put it on our books? Because we don't put it on the books just as one big purchase. We still have 3 different assets. We had that land, we had the building, and we had land improvements. So we have to break them up, and that's what we're going to look at next. How to do something called a lump sum purchase. So a lump sum purchase is when you're paying one amount for various assets. And what we're going to look at is how we can break that total amount up into the different categories. All right, so let's continue on with this one. You can see that I made some changes on the screen, and that was because the example that the book provided actually was incorrect. So I wanted to show you a lump sum purchase, and I wanted to show it to you correctly so that it's easy to follow along the next time. All right, so our example here says that CarMax paid $90,000 cash to acquire a group of items consisting of land that had an appraised value of $30,000, land improvements appraised at $10,000, and a building appraised at $60,000. So that $90,000 cost is going to be allocated on the basis of the appraised values. So what I did was I created land improvements, and building are 3 assets that we're going to have. We have the appraised values listed here. Land was $30,000, land improvements $10,000, and building is $60,000. So that's a total appraisal value of $100,000. We're then going to figure out what percent of the appraised value is each of those assets, because the appraisal is something we can get a real number on what is its value, and we can then take that value and apply it to our actual amount paid. So we're going to take 30,000 divided by 100,000, and we see that it's 30%. So land is 30% of the total appraised value. Land improvements, we take 10,000 divided by 100,000, we get 10%. Building, we take 60,000 divided by, again, that total appraisal value of 100,000, and we get 60%. So as far as the breakdown for appraisals, land is 30%, land improvements are 10%, and building is 60%. So then we're going to take those percentages and multiply it by the amount we actually paid for it, this $90,000. So down here we're going to look at 30% times $9,000. $90,000 comes out to $27,000 as for what we're going to assign as the cost for that land in that lump sum purchase. So land, we're going to debit land for $27,000, and we're going to credit cash for $27,000. For land improvements, 10% times $90,000 is $9,000. So we're debiting land improvements for $9,000, we're crediting cash for $9,000. And then we have building. 60% of $90,000 is $54,000. We're going to debit building for $54,000, credit cash for $54,000. That allocates that entire $90,000 to those three assets. So anytime you have a lump sum, that's what we're going to be doing. All right, so just make sure you use that as an example. You will see it again. If you have any questions, make sure you reach out and let us know. All right, going into the next section, we're going to be looking at computing and recording depreciation. We're going to learn three different methods. The first one is straight line, which we've seen before. We have a new one called units of production, and then we have another one called declining balance. It's also called double declining balance, so we'll see that as we get into it. So let's look at depreciation. Again, it's how we're allocating the cost of that plant asset over the period that we're getting that benefit of that asset. So we're allocating the total cost of it. And there's a few factors we're going to be looking at. The first one is that cost of the asset, that acquisition cost. Remember, it's not just the price we paid for it. It could include that insurance while in transit. It could include the cost of setting it up and getting it ready, testing it out, those kind of things. So that total cost is what we're looking for here. We need to know the salvage value, or the value that it has at the end of our useful life. So does it have a value? Sometimes it will, sometimes it won't. Sometimes we may have a zero salvage value, and that's okay. But what is it worth at the end of that useful life? And then useful life. How long do we expect it to be valuable to our business? So is it going to be 5 years? Do we expect it to last 15 years, 20 years? And that's what we're going to be looking at. So our first method, again, is straight line. So we've seen that before. Straight line is going to be where we're taking our cost minus the salvage value divided by the useful life. So in this example, they show us that we have a cost of $10,000. We have a salvage value of $1,000, and we are going to expect it to be useful for 5 years. So that's the relevant information for the straight line method. Cost minus salvage, which gives us $9,000. That amount is called the depreciable cost, which we see here. We divide that by 5 years, and we're going to be depreciating $1,800 each year. At the end of 5 years, we will have a salvage value left of $1,000. So our entry, remember I told you way back in chapter 3, the entry for depreciation in chapter 3 is the same entry you're going to see when we get into the depreciation chapter. And now we're here. So we've seen this entry before. It's nothing new. So we're going to debit depreciation expense and credit accumulated depreciation. Now you might see it broken down into specific assets. So you might see debit depreciation expense for machinery and credit accumulated depreciation for machinery. Sometimes you may see that. Sometimes it might just be a general depreciation expense and accumulated. But the entry for every one of those 5 years under the straight line method, because it's the same every year, is going to be the same entry. Debit for $1,800, credit for $1,800. That's not going to change. So the straight line method, we can see that the depreciation expense is the same every single year, right? We're depreciating the same amount every year. And what we see is that book value is decreasing by $1,800 each of those years, down to that last year where we end up with that salvage value, that $1,000 after we depreciate that last year. What it looks like on the balance sheet, we're going to have our asset listed, less accumulated depreciation. So we report our net realizable value, or our book value is what this is known as. So this $6,400 is book value. It tells you what the asset is worth to you on your books. So the value that is on your books. The last part I want to show you is a straight line depreciation schedule. So what we're going to see is the depreciable cost, which was that cost minus salvage, that $9,000. Depreciation rate, that is by taking 1 divided by the useful life, and we get 20% each year, and we get the depreciation expense. The next column we see is accumulated depreciation. So depreciation expense is the same every time. Accumulated depreciation is going to increase every year by $1,800, and our book value is going to decrease every year by $1,800. Down to that last year, we're going to end up with our salvage value of $1,000. In our next video, we will continue with our next method, which is units of production.